think you should really be a party promoter.
Thank you. So I'm going to say good morning to everybody, and we are going to start. If everybody would please mute their lines, we appreciate it. We are expecting a big crowd. We've already have over 105 people, and more people are pouring in as we speak. So we definitely appreciate that. It is a CPE credit for any accountants that would like to get the credit. We will have a checkoff box as a follow-up to the email, as a follow-up email to the meeting, if you're looking for that credit so that we can get it over to you. And I want to welcome everybody to the LIFBN. For those of you who don't know, the LIFBN stands for the Long Island Accounting and Financial Professional Network. We officially started about 3 years ago, and I'd say this year was the first time we actually started paid membership during the pandemic in March, when we've been doing meetings every other week. We've had meetings on Medicare, Social Security, a lot of insurance meetings, investments, legal matters, Medicaid, on and on and on. And we continue to provide a top quality education and speakers, and hope that you can participate and consider membership to help fuel our efforts. The board is consistent of professionals in each unique areas of financial planning. Myself, an expertise in insurance, pensions as a wholesaler, and those matters. Larry Shearer, co-founder, estate planning and business succession attorney. Phil Kanyuk, who's on board here, forensic accounting. Larry Bloom, who couldn't attend because he's also on the board of NCPAC, who we're competing with this morning because they're doing their annual big meeting with the CE credits. And Teresa, special thanks out to, with Heartland, who does payroll, who arranged for these speakers today. So very much appreciative. And because it's a 50-minute program, we do want to get started. And thank you so much, Andrew and Mark. Really looking forward to a great presentation on all the up-to-dates on pensions.
Okay. One thing before we get started, we have another scheduled meeting in 2 weeks. That is going to be, Neil, that's with Mark Shine.
Mark Shine, who's an expert in cybersecurity insurance and cybersecurity matters, working with Marshall McLennan. He's also going to have a panel with a forensic accountant who specializes in cyber issues. So we think that'll be a great meeting. We hope you can attend.
Yeah. No further ado.
Okay, thank you so much, Neil. Really appreciate it.
Thank you.
So Mark, if you could share your screen, that would be great.
Oh, any questions, if you want to put in the chat box, we will get to them. Again, because it is a CPE program, we will be time constrained, but we're going to leave time in the end to answer everybody's questions. So
Okay.
Thanks again.
Famous last words. Thank you.
Yeah.
Okay. Next slide, please. Thank you. So once again, I'm Andy Roth. I'm one of the partners at Danziger and Markhoff. My co-speaker today is Mark Hamilton. And I hope you will enjoy the program. Once again, the accountants in attendance will be getting 1 CPE credit for putting up with me and Mark this morning. So Danziger and Markhoff is a law firm. We're based out of White Plains as well as Melville. The primary focus of our firm is employee benefits, where we literally do everything from soup to nuts, except for what the financial planners, the life insurance folks, the investment folks in the audience do, which is the investments. We handle the design, we handle the drafting of plans. We're also an anomaly as a law firm because we're a TPA, which is a third-party administrator. We currently administer approximately 1,800 plans, from small mom and pop plans to plans that are quite large, but our sweet spot is on the smaller side, where we skew the benefits in favor of the business owners, minimize the cost for the staff, and create a lot of flexibility along the way. We also do non-qualified deferred comp work, executive compensation work, and so forth. We have 4 risk attorneys, including me and Mark. We have 7 enrolled actuaries and approximately 20 plan administrators. Next slide, please. Thank you. So before we get into the meat and potatoes of the presentation, since this is sort of, we're moving close to year end, thank God. I mean, everyone is looking forward to being done with this year, certainly. I just wanted to make, a couple of points and make you folks aware of some stuff. So you probably are aware, that your clients have to restate their plans periodically, whether it's their defined contribution plans, which are the profit sharing 401k variety, or the defined benefit plans. So a new cycle now has opened up. The window started back in August 1st. So now all your clients will have to restate their profit sharing 401k plans between August 1st and July 31st of 2022. So just keep that in mind. And it's an opportunity when the plans are restated to enhance them. Maybe the formula is not the appropriate formula. There might be better formulas to create greater flexibility and saving on costs for the staff. I certainly don't like to disparage, the payroll services. Certainly they do a spectacular job when it comes to payroll. But many times the plans that payroll service companies offer or have pretty lousy plan design and service as well. So I'll give you an example. It's funny. One of my colleagues is here in attendance, Peter Opitz. So one of his clients, for some reason, we have a profit sharing plan, and he set up a 401k plan with one of the payroll services. And, of course, they never asked him. They checked off the box immediate eligibility. So, which is okay, whatever, but he didn't want immediate eligibility. He didn't realize it until now. And, Peter goes to his contact at the payroll service, and they say, okay, no problem. We want to change eligibility going forward to, some of you are aware of the standard eligibility, which typically is a 1-year wait with dual entry dates. So you can typically get in between 12 months and 18 months after you start employment, with the client. And it turns out that the person said that we can't change eligibility. It's going to be immediate forever. We can't change it, which is clearly incorrect, but they won't do anything about it. So we'll fix the problem. But these are the types of issues that you have. Sometimes they put in the wrong safe harbor accidentally. Sometimes they don't file the 5,500. So you really have to be very careful. Similarly with bundle plans. I mean, obviously, typically the payroll services have bundle plans, but for example, like the Fidelities of the world are not necessarily the best service providers, and they don't provide the best design either. And typically Fidelity, Vanguard, they like to bundle. SEPs, SEPs, I'm going to go into a little later when we talk about the Secure Act. SEPs, quite frankly, were a great Band-Aid if you miss the end of the year deadline. Now, we can utilize a qualified plan even after the end of the year, but I'll get to that a little later. Unicase basically is a code for a plan for, say, one person with a profit sharing and 401k component to it, or maybe the client or the prospect would like to put away more than the limits. The current limits, by the way, this year, if you're under 50 is 57,000 for an individual. If you're over 50, it's 63.5. The limits have gone up for next year. So the limits for next year, if you're under 50, 58,000. And if you're lucky enough to be over 50, the limit would be 64.5, which includes the $6,500 catch-up, which hasn't changed. Failing 401k plans, easy enough to fix it with safe harbors. And believe it or not, and I'll get to that also a little later in the program, you can even add after the fact, a 3% non-elective safe harbor by December 1st of this year even. It used to be you had to do a notice for next year. Now you can actually implement it by December 1st of this year to fix a failing 401k plan. Plain vanilla profit sharing plans, you see them all the time, where everyone has to get the same percentage as the owner does, or an integrated formula, which is not great either. There's other formulas like new comparability, where you can put everyone in their own category and create a lot of flexibility and saving on staff costs. For some cockamamie reason, every single year we come across money purchase plans. Most money purchase plans, if not all, should have been merged out of existence back at the end of 2001 as a result of ECTRA. It doesn't make any sense to me, but we do see them periodically. So if you come across any money purchase plans, totally unnecessary. Split plan design is another great way. You split the plans up. You have two profit sharing 401k plans or whatever, and you can dramatically reduce the staff costs by doing that. Frozen defined benefit plans, a lot of clients have them. It's sort of an afterthought. It can be, sometimes can be done cheaper if it's outsourced to a TPA instead of done in-house. Overfunded, everyone thinks an underfunded defined benefit plan is bad. Well, an overfunded defined benefit plan is bad as well, because there's a 50% excise tax if the plan terminates, and as well as ordinary income tax. So there are methodologies for certainly dealing with that issue. And then, there's a design prior service defined benefit plans. If any of your clients have a windfall in 1 year, an anomaly where they do great, you can set up these prior service defined benefit plans. We set one up, fairly recently for a somewhat elderly couple that wound up getting a windfall later in life. And we were able to get them a contribution, a combined contribution, a one-time contribution of $1.2 million. So made the accountant for the client very happy. And obviously investment advisors will salivate over a check for $1.2 million to invest. And last but not least, we sort of forgotten about this for a while, because this goes back to 2017, 199A, the 20% qualified business income deduction. So if any of your clients are in a context of a specified service business, whether they're lawyers or doctors or dentists and the like, if you can utilize a qualified plan deduction to drop their income below certain levels, potentially you can get an additional contribution on top of whatever tax deduction you got as a result of the qualified plan contribution of approximately an extra $65,000. So let's not forget about that if you have the appropriate client. So with that, let's go to the meat and potatoes of the program. So I'm going to walk you through some of the CARES Act stuff. And then I'm going to turn it over to my colleague Mark, who is really the expert on the Paycheck Protection Program, and he's going to walk you through that. And he's really the maven on it, and he looks at this every single day to see what changes occur. And then I'll turn it back to me to finish up with the Secure Act. So let's go to the next slide. Thank you. Okay, so it feels like 50 years ago when the CARES Act came out, March 27th, obviously was intended to help people with their cash flow needs and businesses with their cash flow needs. Next slide, please. And I'm just trying to move quickly so we finish up timely and you stay happy with us. Okay, so a qualified individual, and the reason why this is so important is because a qualified individual qualifies for the coronavirus-related distribution relief potentially, as well as the enhanced loan provisions. Of course, the client, the plan sponsor would have to opt in order for the individual or participant to benefit from this. But let's go through the definition of who is a qualified individual. So it's not everyone. So there are two ways to do it. The first way, obviously, is generally the tougher way. That's you or your spouse or dependent was diagnosed with the coronavirus. So that's not a good way to get there. The second way is if you've experienced adverse financial consequences, or your spouse or member of your household, by being quarantined or furloughed or laid off, or your hours reduced, or your child care facility was shuttered, so you need to stay home to take care of your child or children, or if you're a business owner where your hours were reduced in the business, or you had to close the business. And more globally, obviously, if your compensation, your income was reduced as a result of COVID, and unfortunately, that happens, quite frequently, you potentially qualify. Now, all you really have to do is self-certify that you're a qualified individual, and the platforms, they all have different methodologies for doing that. Some have written forms that you fill out and say you're a qualified individual. Others have call-in numbers on a recorded line. So if you do that, then you should be good to go. So once again, you have to self-certify. The only caveat to that, though, is the plan sponsor, if they have actual knowledge to the contrary, then they really can't authorize either the coronavirus-related distribution or the enhanced loans for that individual. But that is an extremely high legal threshold, because let's say someone has a two-income household, and their spouse, not the participant, but the spouse, loses their job, they would qualify. And obviously, the plan sponsor would know the inner workings of the family dynamics. So very, very high threshold. So I wouldn't worry about that if you were the plan sponsor necessarily. Next slide, please. Okay. So once again, I'm going to focus on the coronavirus-related distributions and very briefly the loans, because the loan provision, that ship has sailed, so that really doesn't apply anymore. I have to tell you, of all our clients, I probably personally spoke to 500 of them, and this is not a one-size-fits-all situation. Quite frankly, half have opted in, half opted out. There's no legal obligation to opt in. You can if you want to, but you certainly don't have to. So this is, typically provisions when they go into a plan, they apply universally to everyone, and they're in the plan in perpetuity. With regard to this, they only apply once again to the qualified individuals, and they only last potentially in coronavirus related distributions, only goes through the end of the year anyway. So, here's how it works. If you're a participant and you're a qualified individual, then you can take out as much as $100,000 if your vested account balance is that much. You could take it out anytime during 2020, once again, December 31st is the deadline. It's not subject to your typical mandatory 20% withholding provisions. There would be obviously a 1099 that's issued, but that's just paperwork, no big deal. Next slide, please. It's not subject, however, to the 10% excise tax on early distributions for those individuals that are under 59 and a half. So that's the good news. And then there are three ways to deal with it from a tax standpoint. So the first way to deal with it is you could take the let's assume it's 100,000. You take the 100,000 out, and you can pay tax on it all in 2020. Doesn't necessarily make sense, but you can pay tax on it in 2020 if you want to, and then you don't have to pay it back. That's one way to do it. Another way to do it is to straddle 3 years, 20, 21, and 22, and you can pay tax ratably over the 3 years on that distribution. Excuse me, on that distribution, and still not pay it back. And then the third way to do it is and this would be the best way from a tax standpoint, if you pay it back within 3 years, and I guess we're at November 18th today, if you pay it back within 3 years, so November 18th of 2023, then you can go back and amend your returns for 2021 and 22 to recoup the taxes that I should say, at a bare minimum, the federal taxes that you would have paid over those 3 years. Now, it's interesting. There's like a caveat on the bottom of this page, which is very, very important. It really depends on the state where you are. For some reason, New York did not opt into the CARES Act. So if since New York did not opt in, and most of us obviously are in New York and have New York clients, you have to pay, if you take out the 100,000, you're gonna have to pay New York tax, New York state tax this year, regardless of, even if you pay it back. And if you're a city resident, you have to pay New York City tax. So just keep that in mind. That's sort of a wet blanket to some extent on New Yorkers taking advantage of this particular relief. Now, the other thing I would mention is that even if the plan sponsor did not opt in to the CARES Act provisions, an individual can still, on their taxes, they can still, if they qualify, treat themselves as qualified individuals. If they are able to take their money out of the plan because of a distributable event like a termination or hitting age 59 and a half, or if there's an in-service distribution feature in the plan or a financial hardship. So if they're able to take the money out of the plan anyway, and they qualify, they can personally treat this distribution as a coronavirus-related distribution. So just keep that in mind as well. So that's certainly a good thing for individuals where their employers did not opt in to this feature. Next slide, please.
And Andrew, before you move on, can we did have a question. So companies have been severely impacted in 2020 and may not be able to afford a contribution this year. Can they delay it to 2021? They have the flexibility to eliminate it.
Well, it depends what time, Neil, it depends what type of plan it is. Certainly if it's a profit sharing 401k plan, they're typically, discretionary, so you don't have to necessarily make the contribution. With regard to safe harbors, that's sort of hardwired into the plan document, whether it's the safe harbor match or the 3% non-elective contribution. But quite frankly, to eliminate the mandatory 3% non-elective right now, you have to give a 30-day notice. So that takes you virtually until the end of the year anyway. And then you lose the protection on, passing ADP. So there is flexibility. Certainly you don't have to make a profit sharing contribution. If you don't want to, you're probably locked into the safe harbor. With regard to, we had a lot of issues with defined benefit plans, and we wanted to preempt all of this stuff. Typically in defined benefit plans, you need to either freeze the plan or reduce contributions before you render 1,000 hours of service, which is like in June or whatever. So we were reaching out to a lot of our DB clients, and a lot of our DB clients were freezing their plans, but freezing them for 2020, not for 19. So the contribution for 19, and I'll get to that a little later in a few slides, the contribution for minimum funding for DB purposes normally is September 15th of this year, but it can be delayed till as late as January 4th of next year. So there is a degree of flexibility, but it really depends on the type of contribution and the type of plan involved. Okay, so with regard to loans, and I don't want to spend a lot of time on this because, as you can see, September 22nd was the deadline. The CARES Act doubled the limits. So the 50,000 went up to 100,000. The 50% limit went up to 100%. Once again, I don't want to spend a lot of time on that. But the other thing I wanted to mention is with regard to loans, if you have loan repayments that are due up through the end of the year, you can actually delay them by a year. Interest would still accrue, but you can delay them. Next slide, please. Okay, MRDs, RMDs, whatever, they've been waived for this year. So they were waived for people that had to take their first one by April 1st, meaning for last year, the 19 payable and 20, and they're obviously deferred for 2020 RMDs. This applies to defined contribution plans and IRAs. This does not apply to defined benefit plans. Next slide, please. Okay, this is sort of what I was talking about before. If clients have an issue with regard to their, hopefully they don't, because we're sort of obviously late on this. But if clients that sponsor defined benefit plans or cash balance plans, they have until January 4th of 2021 to make their minimum funding contribution. That would be for 19. However, you would not get the benefit of the deduction for 19 anymore. You would get the benefit for the deduction in 20. So just keep that in mind. So hopefully you folks don't have too many clients or any clients in this situation. Next slide, please. I'm going to skip over this slide. This is really more actuarial stuff where, this applied when the market was tanking. Obviously, the market has come back dramatically. So I'm going to skip this slide as well. It's really not going to apply. So with that, I'm going to turn it over to my esteemed colleague, Mark Hamilton, and he's going to walk you through the salient provisions of the Paycheck Protection Program.
Thanks, Andy. Hi, everybody. I'm Mark Hamilton. I'm a partner here at Danziger and Markhoff. As part of the CARES Act, the Paycheck Protection Program was enacted. The Paycheck Protection Program, I'm sure you all have at least a general knowledge of it. It's basically a forgivable loan program for small businesses that have been adversely impacted by the pandemic. And really, in the way most businesses look at it, it's more like a grant. So if, the trick is that if you spend your money properly, then you don't have to repay it. And just to start off with some stats, there are apparently over 5 million PPP loans, and they totaling $525 billion. The average loan is about $100,000. And the loans are made by commercial banks. They're not made by the SBC, but they're backed by the SBC. So in the event that everything goes well and the loan is forgiven, then it's the SBC and obviously not the bank that bears the economics of that. I'm not going to focus too much on this slide. I'm going to focus really on, I guess, two main topics. One is the forgiveness, because I think most of our clients are entering into, or if they're not in the forgiveness phase. And then I'm going to talk about a few sort of special topics that are sort of off the beaten path. I would just observe that from what I'm seeing with our clients, it seems like the banks are sort of urging PPP borrowers to begin the forgiveness phase and submit their forgiveness application. We don't think that that's such a great idea at this point, because as you all probably know, this has been a really chaotic implementation and rollout, and it continues to confound people as the SBC, which is really sort of a second tier federal government agency, grapples with these millions and millions of loans and billions of dollars spewing out. And the loan application forms have changed, and then the law has changed. So we really think that you should step back and think twice before you submit your application, and just recognize that under the law, you have your client has 10 months after the forgiveness period ends to submit their forgiveness application. So we think you should just kind of slow down and see what the future begins, especially in the lame duck section of Congress. And I'm going to talk about that in a second. So the trick is to spend your loan properly on forgivable expenses. Forgivable expenses include payroll costs as well as certain non-payroll costs, including mortgage, interest, rent, and utilities. But the lion's share is going to be payroll costs. And under the law as amended, or I should say originally the SBC imposed a 75% rule. The SBC on their own, this is not in the CARES Act itself, said that you're going to have to spend, they sort of looked at the legislative purpose of this and said, we think 75% of your loan forgiveness amount should be spent on payroll costs. I'm going to talk about how that rule has changed, but clearly it's mostly payroll costs. And payroll costs include not only cash compensation, but also retirement plan contributions. And the whole retirement plan contributions aspect of it has been somewhat ambiguous. Some clarity has come to it, but one example of the ambiguity is this FAQ that's on this slide. So I guess about a month and a half ago, the SBC issued these loan forgiveness FAQs. And one of them said that forgiveness is not provided for employer contributions for retirement benefits accelerated from periods outside the forgiveness period. As we all know, retirement plan contributions are determined on a plan year basis, so it's not really completely clear what that means. It may mean that you can't use PPP proceeds to fund benefits that accrue after your forgiveness period. So your 8-week or 24-week forgiveness period following your loan disbursement date. What we think you can do, or what your clients can do, is to use PPP proceeds to fund, for example, the 2019 contribution. And as long as that contribution goes into the plan during your 8-week or your 24-week spend period or forgiveness period, we think that should be an appropriate use of funds. But quite honestly, now that I'm going to talk about this in a second, but the original 8-week spend period for most borrowers has now been expanded to 24 weeks. So there's a lot less pressure to spend the money very, very quickly. And some of our clients were using the retirement plan contributions to sort of sop up whatever they had left. That pressure is sort of, for the most part, gone away now that they have up to 24 weeks to spend their PPP money. At the bottom of the slide, I just wanted to talk about an income tax sort of anomaly. Congress sort of tried to do the right thing and said, everyone's under this financial stress. We know normally under general tax principles, when your debt is forgiven, you have to recognize this sort of phantom income for federal income tax purposes. And the CARES Act, while it did not amend the Internal Revenue Code, said that, no, in this circumstance, we're not going to tag you with cancellation of indebtedness income if your PPP loan is forgiven. Unfortunately, the IRS, shortly after the enactment, came out with a notice that said that just under existing tax law, if your loan is forgiven, then you're not going to be able to claim a tax deduction for those forgivable expenses that you spend your PPP proceeds on. And you can see that essentially renders this provision meaningless, because if you can't take a tax deduction, then you lose that tax shield that's normally associated with spending on retirement plan contributions or whatever. I think this notice is sort of flies in the face of the legislative intent. And I really don't think the notice is sort of mandated by a reading of the Internal Revenue Code. But nevertheless, it's out there. And the notice is sort of creating this mismatch, because you're probably going to be spending your money in 2020, but you won't claim forgiveness, or you won't even know that you're getting forgiveness until 2021. So I don't think there's, and maybe some people can think about this, but I don't think there's really a consensus among the community yet about whether or not a borrower who in the ordinary course expects at some point their loan to be forgiven, whether they should claim a tax deduction for their forgivable expenses and then maybe file an amended return or something like that. And then you also have the possibility that Congress could just change the law and override the IRS, which they can certainly do. So there's a lot of uncertainty out there. Again, all the more reason not to rush in doing your forgiveness application. When this IRS notice came out, Congress, Rubio, and some of the other characters said, no, that's not what we intended. And there was even a bill that was introduced to override this tax provision of this tax position, I guess I should say, of IRS. But to date, it hasn't been enacted. I'm going to talk about that slide in a second. Okay,
Hey, Mark,
so
before you move on, we had a lot of questions, so I just want to get to them real quick. Does the payroll costs include employer FICA?
Yes.
Yes. Okay. And then if the loan's not forgiven until 2021, should the offset on costs be in 2021 or in 2020?
Oh, that was what I was talking about. It's not clear what the consensus is on that.
Okay. And then the PPP forgiveness, does it include health insurance benefits paid by employers to employees?
Yes. That's a quote unquote payroll cost within the PPP law.
Okay. And I think that's all we got a couple more with PPP loans, but you go on and we'll move forward.
Okay, thanks.
Thank you.
So back in June, Congress enacted the Flexibility Act. Sadly, this crisis that we're going through wasn't alleviated in 8 weeks. So Congress actually uncharacteristically acted very appropriately and very quickly to pivot and extend the 8-week period to 24 weeks, which was really welcome. And they reduced, as I said, the 75% regulatory limit or requirement to spend on payroll costs to 60%, liberalizing that, all good news. There was some liberalization about businesses that have to reduce their headcount. I haven't really mentioned that, but within the PPP, there's an incentive to maintain headcount and compensation levels at sort of your loan levels. And in some circumstances, if a borrower can't maintain that level and they don't restore it by December 31st, then their loan forgiveness amount gets reduced. But those calculations are very very complicated, and there's some relief to that. Yeah, so that's the Flexibility Act. And okay, so this slide talks about payroll costs. So, you know, payroll costs are king. It's called the Paycheck Protection Program. So it was meant to encourage employers to keep their folks on payroll. But there are limitations. So the first limitation, the fundamental limitation that's within the PPP itself, is this $100,000 per employee limit. And so the way that works is the $100,000, you're limited to claim forgiveness up to $100,000 of payroll costs prorated for the forgiveness period. So originally it was 850 seconds of 100,000, but now that the Flexibility Act expanded the forgiveness period to 24 weeks, SBA has confirmed that your per employee payroll cost cap for cash compensation is 46,154, which is 24 weeks of the $100,000. So that's for staff. Pretty early on in the rulemaking process, the SBA started saying that we're going to kind of have a different set of rules for owner employees. And we were sort of like, okay, owner employees, can you give us a definition of that? And there was no definition. So it was the owner employee thing has been kind of an ongoing thorn in our side. But thankfully, with the fullness of the regulations, the so-called interim final regs or rules, and these FAQs, which SBA is making law by issuing these dozens of FAQs, it's become somewhat more clear as to what owner employees are and how they're capped. Owner employees, the SBA has said that if you're a less than 5% owner, we're not going to treat you as an owner employee. So for example, if employees get restricted stock or something like that as an incentive compensation, they're not necessarily going to be tagged with these owner employee limitations. And the sort of the philosophy, if you can divine one, of the SBA with owner employees, it's sort of like they're viewing this as sort of income replacement. So there's sort of a reference back to what happened in 2019, and they really don't want you as an owner employee to be using your PPP funds to feather your nest in excess of sort of what your historical compensation was. So in that vein, the cash compensation for owner employees is capped at the lesser of $20,833, which is 2.5 months of the $100,000, or 2.5 months of your 2019 compensation. So it's the lesser of those two. So your whatever you did in 2019 is sort of limits what you can claim and what you can claim for forgiveness. There's a separate bucket for retirement contributions for owner employees. So owner employees of S Corp or C Corp owners are capped at 2.5 months of their 2019 retirement plan contribution. And then for whatever reason, if you're a sole proprietor or you're a partner, you cannot use PPP proceeds to fund retirement plan contributions for yourself. And I've really tried to figure out what the rationale for that was. And I've sadly not been able to really figure that out. So a lot of these rules seem somewhat arbitrary, and that's certainly one of them. I think I'm going to skip this. If you get the materials, you can look at some of these. Some of these slides deal with the sort of the relief that's been given here and there for businesses that really have not been able to successfully reopen. So this is the proposed legislation. So this is not the law currently. This is proposed, and it's really a very, very, very attractive proposal, and there has been some talk that maybe it might be revisited in this the lame duck session of Congress. And it has a few nice features. It expands the types of forgivable non-payroll expenses that you can spend your money on. It vastly simplifies the loan forgiveness process if your loan is $150,000 or less. Remember, we said that the average loan is somewhere around just north of $100,000. So this would sweep in a lot of clients, a lot of borrowers, and they wouldn't have to fill out those really detailed forgiveness applications. There's even a second draw program where some more money is available if you need it. And really interestingly, the covered period, so that infamous 8-week, now 24-week period, if this law were passed, a borrower could actually choose its forgiveness period. So it would be any period that begins on the date their PPP loan is dispersed, as long as it's at least 8 weeks and ends prior to December 31st. So that would essentially alleviate any sort of pressure, assuming you can reopen, to spend your money. But again, this is not law, it's just a proposal. The SBA of its own volition used its authority to basically more or less give a pass if your loan is $50,000 or less. So in some recent interim final rule, the SBA had said that as long as your loan is $50,000 or less, you're just gonna have to fill out a one-pager, attest that you used your money properly, and then you're good to go. And as you can see, the stats are, that's a lot of loans, right? 3.57 million loans fall into this category according to the SBA. So that's going to give, that is existing relief, and that's going to give pressure, relieve some pressure on the very small borrowers. So this procedural notice, this is one of the latest and greatest developments. I shouldn't say greatest, but one of the latest developments in PPP world. So SBA, I guess around a month or so ago, issued some clarification about if you have a change in ownership of a PPP borrower. So if a PPP borrower has an outstanding loan and they have a sale of the company, then certain obligations are triggered. So a change of ownership is the term of art that the SBA is using. And it's a sale or transfer of 20% or more of the equity, 50% or more of assets, or any merger of a PPP borrower. And if you do have a change of ownership, the borrower has to notify its lender promptly, and then the lender is required to notify the SBA. And then there is a possibility that you might have to get SBA approval of your transaction, which is really bad, right? Because you don't want a federal government agency telling you whether you can sell your business or not. So there are some exceptions to getting SBA approval. Not surprisingly, if the borrower has fully repaid its loan, the SBA doesn't care anymore. And also if the borrower has completed its loan application and basically everything's done, the SBA has remitted the funds back to the lender and the borrower has paid whatever balance is due, then they don't have to seek SBA approval. If you don't fall into any of those categories and you basically have a 50% sale of equity or assets or any merger, then you have sort of two alternatives as a PPP borrower. You can complete your loan forgiveness application reflecting the use of all your PPP funds, and then you have to fund an escrow, an interest-bearing escrow with your lender with the balance of your PPP in an amount equal to the balance of your outstanding PPP loan. And a transaction that I recently worked on that was post this procedural notice was interesting. There's all sorts of reps and covenants and stuff in the purchase agreement around this issue where your target company has an SBA PPP loan. And then the way the flow of funds worked is part of the purchase price was actually coming from the buyer, and then that was going to fund the PPP escrow with the lender, which I thought was an interesting way to deal with it, using some of the liquidity that's generated from the sale to fund this interest-bearing escrow. If God forbid you can't come with any of these exceptions, then you're going to have to submit a request to the SBA for approval of your transaction. And the SBA has said that I think it has 2 weeks. 8 weeks to approve your application. And I'm sorry, 60 days. So the SBA has said that if you submit an application for approval of your change of ownership, they have 60 days to get back to you. But as we know, this whole process has been chaotic and unpredictable, and you're dealing with an overburdened second-tier regulatory agency. So who the heck knows whether they're going to get back to you in 60 days. And the SBA has said, what's more is if you have an asset sale, their approval is going to be conditioned on the buyer assuming the seller's PPP loan. So really, that's just sort of a last resort, is you want to try to avoid, like the plague, having to go for SBA approval. Another late-breaking development is this loan necessity questionnaire. So if you all remember, back, I guess maybe in April or so, it's sort of towards the beginning of the process, over a weekend or something, SBA came out with this infamous FAQ 31, which basically said that if you didn't really need your money to keep your business afloat, we SBA are gonna question you, and you may be in jeopardy for criminal sanctions. And so a lot of our mom and pop clients and what have you were just sort of like, oh my God, what's going on here? They're going to be looking, in my books and everything, and I got $50,000. I'm gonna have to pay it back, and blah blah blah. So within a week or so, I guess, basically responding to the pressure from Congress and other constituencies, the SBA walked back on that and said that essentially, if your loan is less than $2 million, you're going to be conclusively presumed to have needed your loan. So that was really welcome. But for those way out on the tail of the disbursement of loans, if you have $2 million or more, they said we are going to audit you. So this process will probably go on for many years, but sort of as an opening salvo in this $2 million or more world, the SBA issued this loan necessity questionnaire to quote unquote inform the SBA's review of the borrower's good faith certification of the economic uncertainty that generated the need for the loan. And just kind of humorously, but not so humorous, if you get this questionnaire, it's 10 pages long with a lot of quantitative and qualitative questions about your business, and you have 10 business days to complete it. So probably what would be good if you have $2 million or more is to get your hands on a copy of this questionnaire, even maybe before you get it from your lender, and start filling it out, because it's a bit of a challenge, and they don't give you a heck of a lot of time to fill it out. So at the bottom of the slide, you can sort of see, kind of reading from the tea leaves, what the SBA is sort of getting at with this questionnaire. And it's sort of, again, it's necessity. Did you really need it? So there's questions concerning, did you have significant cash on hand at the time you filed your application? So maybe you didn't need it. Did you use your proceeds to pay dividends to owners to prepay debt during the forgiveness period? Well, that's an indication that you probably didn't need it for ongoing operations. Did you pay what the SBA, I guess, thinks of as exorbitant compensation for owners, the $250 or $250,000 or more on an annualized basis? So those, I guess, are sort of the hot button issues that the SBA is going to probably spend years and years auditing and examining these sort of mega borrowers, who constitute, by the way, if your loan is more than $2 million or more, I think you're in like the top 0.1% or something by loans, by number of loans. So so there's that. I'll just try to go quickly through the rest of this. PPP fraud. We've probably all read those sort of humorous anecdotes in the Wall Street Journal and the Times about PPP borrowers, a Florida man who didn't really have a business, didn't have any employees, but got a loan anyway, and then went to Vegas and bought an exotic sports car and what have you. The fact that that's occurring is no surprise to anyone. Whenever you have like billions of dollars sloshing around with very few strings attached, the bad guys are going to come out from under their rocks and get their piece. But what is interesting is that the SBA officials have said that this sort of blatant fraud is the smallest, teeniest piece of the iceberg of PPP fraud. And the numbers sort of bear it out. If you see in the middle of the slide, it's kind of shocking. Last year, the SBA fraud hotline fielded something like 800 calls. This year so far, they've gotten 42,000 reports of PPP fraud. So there's a lot going out there sort of under the radar. One example of PPP fraud that is not so obvious begins with a perfectly ordinary situation. You have the borrower has a real business and they're really suffering due to the pandemic, all sorts of problems. They get their loan application, they fill it out, and everything's on the up and up. They do the numbers right, and they deserve the money. They're entitled to it under the PPP loan, but then things sort of start to go off track. Perhaps the borrower is shuttered and the employees are still at home. Maybe they're not operating. Maybe they were still under the 8-week period and they were really nervous that they weren't going to be able to spend their money quickly enough. So what some borrowers have evidently done is they've treated this use of PPP proceeds for payroll costs as advances to their employees, so loans to their employees that get recouped once the employees come back to work. So once the employees come back, the employer purports to deduct the payments that they made using their PPP proceeds from future compensation. And then you can see it's a sort of circular flow of funds that the money has now come back to the employer, and the employer can deploy it in any way they want. That's illegal. Loans and advances to employees are not payroll costs. And what's more, states have very draconian wage withholding laws, some of which have criminal penalties. So this is a scenario that you and your clients don't want to get involved with. I'll wrap it up now and I'll take any questions, but wrapping it up, the SBA issued a fraud alert in connection with the PPP. You know, this is sort of common sense stuff, but it always bears reminding that the SBA doesn't initiate contact with potential borrowers for the PPP program. The SBA or anybody else should not be charging exorbitant upfront costs to get a loan. If you get an email, look at it twice. It should be sba.gov, not sba.com or sba.org. And even the SBA logo has been ripped off and is being apparently used fraudulently. And then there's a phishing scheme that we've heard about. Again, you know, not rocket science and sort of predictable, but it leverages off that FAQ 31 that I mentioned before. And the fraud involves an email that purports to be from the SBA saying, hey, borrower, we're the government, you know, we know you didn't really need your money. Call the SBA attorneys to establish a repayment program. You know, fraud, it's just fraud, phishing, just in an effort to separate your clients from their money. So just stuff to look out for in this crazy world that we're living in right now. Neil, are there any questions that?
I mean, there was a few. As everybody, is there any additional questions that we didn't get to, or? Anybody want to just
access to the questions? So.
Okay.
But we don't have a lot of time, so maybe Andy should get started on the Secure Act.
Okay. Yeah, Andy, why don't you finish that, and then we'll wrap it up. And then again, we're going to give everybody's information if there's questions afterwards. I know we have to get the CPE credit in, so I didn't want to, you know, kill us with questions at this time. So
yeah, well, yeah, thanks, Neil, and thanks, Mark. So yeah, I'm going to zoom through this really fast because I do want to, you know, get you out of here on a timely basis. So very quick. Normally I go through this in more detail, but I just want to hit the high points here. So you probably know this by now. Required minimum distributions normally start the April 1st following the year you hit age 70 and a half. Age 70 and a half has been now increased to age 72 for those people born on and after July 1st of 1949. And then also there's a proposal out there. We'll see what happens, that will raise the age from 72 to actually 75. So we'll see. Next slide, please. So this is a bad thing that happened in the Secure Act. And once again, the Secure Act was enacted at the end of 19, which feels like 100 years ago. So we used to be able to stretch things out in terms of distributions and all that. So the old rule still applies for spousal beneficiaries. Life expectancy applies, but for not generally speaking, there's an exception here, but generally speaking for non-spousal beneficiaries, the limit is 10 years. You don't have to do anything, but you have to get that money out at the end of the 10th year. So you can, you know, not take any distributions for 9 years, 11 months and 30 days, but it has to come out by the end of the 10th year for non-spousal beneficiaries receiving distributions. Next slide, please. I alluded to this before, very important slide, which sort of minimizes the importance of SEPs. It used to be SEP was the Band-Aid. Now you can actually implement the plan after the end of the year. You don't have to sign it by the end of the year. You can do it within the time frame in which your client files their taxes, including extensions. We still encourage, of course, plans to be done by the end of the year, because a lot of our clients like 401k plans. 401k plans obviously are funded out of payroll. Once you go into the following year, payroll is gone. Also, having a successful 401k element, it reduces the staff costs, which we myopically focus on. And it also helps the accountants in attendance with their tax planning as well. So a very nice thing. If your client's asleep at the switch at the end of the year, you do have until the following year, the tax filing deadline, to implement that plan. Next slide, please. Okay, safe harbors. I alluded to this before. With regard to the rule on the safe harbor match, that hasn't changed. So your clients that have safe harbor matches, they still will have to give a notice by December 1st for next year. However, if you have a situation where your client is failing the ADP test, the average deferral percentage test, you can implement the 3% non-elective safe harbor by December 1st, believe it or not, and it will apply for the current year. And if you wait even after that and you bump the 3% up to 4%, even into next year, you would satisfy the ADP test, or the ADP test would be avoided. So that, is certainly a good thing to keep in mind. And there is no more 30-day notice requirement for the 3% non-elective, but there's the same rules, the usual rules apply for the 4% match. Next slide, please. Okay, very quickly, in the old days, I wouldn't even care about this. Big deal, a $500 credit. Now the credit can be as much as $5,000, depending upon the size of the plan. So if your client has 20 non-highly compensated employees in the mix, they can qualify for a new plan for a $5,000 credit for the first 3 years of the plan. And it has to be small employers, 100 or less employees. Next slide, please. Okay, so here, we're all probably aware of the rule. You can exclude part-time people from qualified plans, but you're going to have to start, or I should say your clients are going to have to start including long-term part-time employees, those employees that render at least 500 hours during the preceding 3 years. So this starts, we have to start counting next year. So in 21, 22, and 23, if your clients have people that are long-term part-time employees, meaning those that rendered at least 500 hours but less than 1,000 hours, they would have to be included in 2024. So we're a long way off, but we have to start counting next year. There's a proposal which will reduce the 3 years to 2 years. So we'll see. But the good thing about this is, even though it's a bookkeeping issue, the good thing about this is, if those part-timers come in, your client does not have to give them an employer contribution, a safe harbor contribution. They only have to come in for 401k purposes. If your plan is top-heavy, and most of you know what that means, you don't have to give a top-heavy contribution to those employees either. Next slide, please. And I think we'll skip over this and we'll skip over the following slide. We'll go to we'll skip that just in the interest of time. Yeah, so once again, if you have any questions, we're going to send, Neil, I'm assuming you'll send everyone, hopefully, the presentation, so they'll have our contact information.
Absolutely.
Okay, but so you'll have that. I just want to make, and I know we zoomed through this and, your questions were spectacular. I'm giving a presentation, which coincidentally today at 12, called Sales Tactics for Growing Your Assets Under Management Using Qualified Retirement Plans. That's at 12 o'clock. So if any of you are interested, reach out to me, aroth@dmlawyers.com. It would be certainly appropriate for any of you investment folks, life insurance folks, any CFPs in the audience. You'll get 1 credit for putting up with us for an additional hour. And there's a question, how the
CPE, what we're going to do is we're going to send a follow-up email to everybody, and anybody interested in getting the CPE will send us a follow-up email, and we'll make sure you get the CPE credit.
Great.
That answer
I hope.
Someone's question?
So we'll get you the slides. We'll provide you with the credit, the accountants once again.
Yep, we'll take care of all that.
And Neil, I just want to, thank you so much for the opportunity. Absolutely spectacular, incredible attendance. And, we look forward to, doing things together with you going forward as well. And I just want to thank you on on Mark's behalf as well. It was a
Thank you.
spectacular event. And thank you.
Thank
for
you. You
organizing
guys
it.
are stars, like Keith Richards and Mick Jagger. What can I tell you?
Thanks, Neil. We had a great time.
Yeah,
Thanks,
thanks.
Neil.
And thanks everybody for attending. And in 2 weeks, we're going to have another great meeting. And again, I hope you can take some time to look at the LIFPN website. We are educating. We have resources for everybody. We like to work as teams and help our clients get the best advice all the time. And that's what we stand for. So thanks again.
Thank you.
Happy Thanksgiving, everybody.
Good day, everybody.
Be safe.
Enjoy.
Thank you.
Have a happy and
Happy
small
Thanksgiving.
Happy
Thank
Thanksgiving.
you all. Thank you so much.
Thank you.